Hello, guys. What is happening? And welcome to this live stream. So, before we click that like button, because people are going to need to see this one, this is not going to be getting any sort of coverage on the mainstream media. And it is a sign of fragility within the banking system. Now, we don't have a direct insight to the banking system here in Canada. Nobody does. But let's think about things and think about what's going on. So I got to hand it to Jeff and Emil because they described this brilliantly on a podcast that they did recently. And I've linked it in the description, also a link to their YouTube channel where you can check it out for a more in-depth macro dive into what's going on. But the thing is, guys, the same exact thing that's going on in the United States is going on here in Canada as well. So the first thing that I'm going to need you to think about is there's this thing called the repo market. Now I'm gonna keep things very simple. So the repo market is basically a place where banks, primary dealers can go and park their excess reserves in the banking system with the Bank of Canada or the Fed. So they can go there and park their excess reserves with the Fed, and the Fed will pay them this interest rate, which is currently, I don't know, around 92 basis points. We're just going to see in a second here. So 0.92%. But there's something interesting going on, which only happens when there is a collateral shortage. So there's a shortage of liquidity in the system. So despite the Bank of Canada and the Federal Reserve thinking that the system is full of liquidity, there's too much liquidity, we need to suck the liquidity out of the system, it is quite the opposite is what we're seeing. And it's a sign, it's a bad sign. If you think of it like an engine and it's all lubricated, and the lubricant is basically the collateral of the financial system, the liquidity. Once that liquidity dries up, the gears, they start to not turn properly, and you start to get issues. Parts of the market seize up, and that becomes a real issue. So basically, anyway, let me show you without further ado so we can actually see this here. But basically, this is from the Bank of Canada's website. And this will be easy for you guys, I think, to get your head around. I'm going to keep things very simple on this. And as I said, if you want more of a deep dive into it, check out Emil and Jeff. They're fantastic minds on this, and they really know their stuff. So anyways, let's take a look down here. So right down here, the Bank of Canada has a chart, and the Federal Reserve puts out a similar thing. And you can basically see that the overnight repo rate is 0.96%. So basically, banks are parking their excess reserves with the Bank of Canada, which is completely risk-free, and they are getting 0.96% for doing that. So that's all well and good, but there's something that is going on that shows a warning sign, and it's this. So if we now mosey on over to the 1 month Canadian bond, so there's a 1 month Canadian bond, and we're going to check the yield out with that, you'll see that it's at 0.88. So it's actually below the overnight rate. So you have to think about that. So somebody parking their excess reserves at the Bank of Canada, risk-free, is getting a higher rate than somebody who is buying a 1 month government bond. So why is that? And that's precisely the question that I want you to ask yourself, because now if you've understood and followed me to this point, you can realize that, hey, why would somebody buy a 1 month bond? And the reality is somebody would buy a 1 month bond because there is a collateral scarcity, and the 1 month bond has a lot of different use cases, more so than parking the reserves with the Bank of Canada. So this is why this happens. This generally happens when there's a collateral shortage. So it's only like 8 basis points or 9 basis points away from each other, 0.09%. But get this, guys, if you buy a 1 month bond right now, there's a 50 basis point hike that is coming in like 11 or 12 days. So that 50 basis point hike is going to come, and obviously the 1 month is going to rise. So why would somebody buy it? And this is the my exact point here. There's something fundamentally wrong. Something fundamentally is going wrong within the financial system, and that's something that we want to pay attention to and watch. Now, in the United States, the exact same thing is happening right now, and it's a big issue. It can be a sign that there is collateral scarcity within the system. The liquidity is drying up, like I said. And bear in mind that we are going into a time where the Bank of Canada and the US Federal Reserve are going to be doing in the US. They're already doing, I think, in Canada, the quantitative tightening. So they're going to be sucking liquidity out of a system that is already in the absence of liquidity. So it's a big, big problem, and it's something we got to pay attention to. Now, in the United States, even the 3 month Treasury bill, which is the 3 month bond on government debt, even that is yielding less than the RRP rate, the repo rate at the US Federal Reserve. The same thing, guys. You've got to think. Just think the bank has got its excess reserves, it's got its cash, and it parks it at the Fed, and the Fed is going to pay it the RRP rate. And you can literally, like, if you're buying that 3 month Treasury bill, why would you buy that? Like, there's maybe 3 hikes coming in that bill. So the return. So obviously, there's a liquidity premium that is being paid, and that is why people are buying this 1 month bond. That's why they're buying the 3 month Treasury, the 1 month Treasury. And it's a sign, it's a hallmark that liquidity is drying up within the financial system. And it's not good news. It is a issue, and it's something that we are going to continue to pay attention to. Now, anyway, guys, I wanted to keep this fairly short, so I'm going to keep it short, unlike most of my live streams. I got another live stream coming, by the way, in an hour or so, I think it is. But anyway, guys, the thing to remember with this is it's liquidity. Liquidity within the financial system, within the banking system, is drying up, and there is problems within it. We're starting to see the cracks in the financial system. You're not going to hear this anywhere else on the mainstream media or anything like that. So it's very important to pay attention to. But anyway, we'll continue to monitor it. If you want to look at a more deep dive into things, check out the podcast and the links in the description. And I'm hoping I described that well. But Emil and Jeff are much smarter minds on this than I am. But I hope you kind of understood what I was talking about there. It's pretty simple stuff. Banks parking money with the Bank of Canada and the Federal Reserve. That is what the RRP rate is that they are paid. And this 1 month bond that obviously you're going to hold for 1 month and then get paid the return 0.88% or whatever it is. And that's lower than if you just park it at the Fed or the Bank of Canada. So there's a sign of problems there. It's a sign of weakness, and you won't see any of this in the mainstream media. That is for sure. Anyway, guys, thank you so much for watching. Please hit the like button on this one. We're really going to need the like button to be hit on this one, because I have a feeling that nobody is going to probably watch it. But anyway, guys, thank you so much for watching. I'll see you in the live stream later. Take care of yourselves. Peace and love as always, guys.